You saved $120,000. Most Americans will never do that, but right now, tonight, that money is quietly working against you and you don't even know it. Stay with me, because the next 10 minutes might be the most important financial conversation you've had all year. What's up, everyone? Welcome back to the channel. If you're new here, this is the place where we talk real money, real strategies, and zero sugarcoating. Now, before we get into it, I want you to imagine two people. Both of them saved $120,000. Same income, same discipline, same sacrifices. 5 years later, one of them has grown that $120,000 into over $210,000. The other one? Still sitting at around $118,000, barely keeping up with inflation, actually losing purchasing power every single day. Same starting point, completely different outcomes. What was the difference? It wasn't luck. It wasn't some stock tip. It wasn't crypto. It was 5 specific moves, 5 decisions made early that completely changed the trajectory of their financial life. And that's exactly what we're covering today. If you have $120,000 saved or anywhere close to that, these 5 things are not optional anymore. These are urgent, and I mean that. Let's get into it. Move 1. Stop letting your emergency fund collect dust in a regular bank. Alright, move number 1, and this one is going to sting a little. If your emergency fund is sitting in a traditional checking or savings account at a big bank like Chase, Bank of America, or Wells Fargo, you are literally donating money to them. Here's the data. As of 2026, the national average interest rate for a standard savings account at a big bank is still hovering around 0.45% APY. That's not a typo. 0.45%. Meanwhile, high-yield savings accounts? We're talking 4.5% to 5.1% APY at places like SoFi, Marcus by Goldman Sachs, and Ally Bank right now. Let me put that in real dollars for you. $20,000 sitting in a Chase savings account earns you about $90 a year. That same $20,000 in a high-yield savings account? That's $900 to over $1,000 a year. That's a free $900 just for moving your money across the internet. No risk, FDIC insured. Takes about 15 minutes to set up. Now here's the important part. Your emergency fund should be 3 to 6 months of your expenses. That's it. Don't keep more than that in cash. Everything above your emergency fund threshold should be working harder. Which brings us to move number 2. Move 2. Understand the real battle: high-yield cash versus market investing. Okay, so now you've got your emergency fund optimized. You've got, let's say, $15,000 to $20,000 in a high-yield account earning 4.8%. But what do you do with the remaining $100,000? This is where most people freeze. And freezing is the worst financial decision you can make. Because inflation in 2026 is still running between 3.2% and 3.8%, which means every single day your money isn't growing at least 3.5%, you are getting poorer, slowly, silently. Here's how I want you to think about this. Cash in a high-yield account is your defense. It's protection. It's stability. It's sleep-at-night money. Market investing is your offense. It's growth. It's wealth building. It's the engine. You need both. But most Americans are playing 100% defense and wondering why they're not winning. Now here's the real talk on market investing in 2026. The S&P 500's average annual return over the last 30 years is about 10.7% before inflation. Even accounting for down years, 2022, 2023 volatility, the early 2026 corrections long-term, the market rewards patience. If you invested $80,000 into a simple S&P 500 index fund today and left it alone for 20 years at a 9% average return, that becomes $448,000. Without adding another single dollar. That's not magic. That's compound interest doing what it does. But here's the catch. And this is what move number 3 is all about. How you invest matters just as much as if you invest. Move 3: max out every single tax-advantaged account before you touch a brokerage. This is the move that separates people who build real wealth from people who just accumulate money. Tax-advantaged accounts. And in 2026, these limits have been adjusted, so let's go through them. Roth IRA, you can contribute up to $7,000 per year if you're under 50, $8,000 if you're 50 or older. The money grows tax-free. You pay taxes now, but every dollar of growth, every dividend, every capital gain comes out tax-free in retirement. This is one of the greatest legal wealth-building tools the IRS has ever allowed. And most Americans aren't using it. Traditional IRA, same contribution limits. But here you get a tax deduction now, pay taxes later. Great if you think your tax rate will be lower in retirement. 401k, if your employer offers one, the 2026 contribution limit is $23,500 per year. And if your employer matches contributions, that is free money. If your company matches 4% and you're not contributing at least 4%, you are leaving your own paycheck on the table. That's not strategy, that's just giving money back to your employer. HSA Health Savings Account. This one is criminally underused. If you have a high deductible health plan, you can contribute $4,300 as an individual or $8,550 as a family in 2026. And here's why this is incredible: it's triple tax advantaged. Contributions are pre-tax. Growth is tax-free. Withdrawals for medical expenses are tax-free. After 65, you can withdraw for anything with normal income tax, just like a traditional IRA. This is the stealth retirement account almost nobody talks about. So here's the priority order for your $120,000 strategy. First, employer 401k match. Boys, non-negotiable. Second, max your HSA if eligible. Third, max your Roth IRA or traditional IRA. Fourth, go back and max your 401k fully. Fifth, anything left over goes into a taxable brokerage account. If you follow that order, you are legally minimizing what the IRS takes from your wealth. And over 20 or 30 years, that tax optimization alone is worth hundreds of thousands of dollars. Move 4: the debt strategy most financial gurus get wrong. Alright, let's talk about debt. Because a lot of people watching this, you've got $120,000 saved, but you also might have debt, student loans, car payments, maybe some credit card balances. And here's where most financial advice gets it completely wrong. They say, pay off all debt first. That sounds safe, that sounds responsible, but mathematically it could be costing you a fortune. Here's the framework I want you to use. It's called the interest rate threshold strategy. High-interest debt above 7%, pay this off aggressively. Credit card debt at 22%, 24%, 27% APR, that's a guaranteed 27% return just by eliminating it. No investment consistently beats that. Attack this first. Medium interest debt between 4% and 7%, this is the gray zone. A 6% car loan or a 5.5% private student loan. You need to compare this against your expected investment return. If the market is returning 9% and your loan is 5.5%, the math says invest while making minimum payments. But emotionally, some people sleep better paying it off. Both are valid. Make a conscious choice, not a default one. Low-interest debt below 4%, do not aggressively pay this off. Federal student loans at 3.2%? A mortgage at 3.5% from a few years ago? You'd be making a huge mistake throwing extra money at that. Every extra dollar toward a 3% loan is a dollar that could be compounding at 9% or 10% in the market. The key insight here is this. Not all debt is your enemy. High-cost debt is your enemy. Cheap debt used wisely is actually a tool. If you've got $120,000 and you have high-interest debt, here's the truth: you don't actually have $120,000 in net wealth. Calculate your real net worth first. Assets minus liabilities. Then build from there. Move 5. Protect your wealth, the step everyone skips until it's too late. Okay, we're almost at the finish line. Move number 5. And I saved this one for last because it's the one almost everyone ignores until something terrible happens. Wealth protection. You've built $120,000. Maybe it took you 5 years, maybe 10 years, maybe even longer. And one medical emergency, one lawsuit, one car accident, one unexpected death in the family can wipe it out completely in months. This is not fear-mongering. This is math. And this is reality. Here's what wealth protection looks like in 2026. Term life insurance. If anyone depends on your income, a spouse, kids, aging parents, you need term life insurance. A healthy 30-year-old can get a $500,000 20-year term policy for around $25 to $35 a month. That's less than a Netflix subscription. If something happens to you, your family doesn't lose everything you built. Disability insurance. This one is actually more statistically important than life insurance for most working Americans. You are 3 times more likely to be disabled for 90 days or more during your working years than to die during that time. If you can't work, what happens to your savings? Disability insurance replaces 60% to 70% of your income. Check if your employer offers it. If not, get a private policy. Umbrella insurance policy. If you've got over $100,000 in assets, a standard umbrella policy gives you $1 million in additional liability coverage for around $150 to $300 per year. That's protection against lawsuits, major accidents, and claims that exceed your regular home or auto insurance limits. A basic will and beneficiary check. This costs almost nothing. But if you die without a will, the state decides where your money goes. Not you, not your family, the state. In 2026, there are apps and online platforms where you can create a legally valid will for as little as $100. And please check the beneficiaries on your 401k, IRA, and life insurance policies. These override your will. People forget to update these after divorces, deaths, and life changes, and the wrong person ends up with the money. Protecting wealth is just as important as building wealth. Don't skip this step. So let's bring this all together. You've got $120,000. Here's your exact action plan starting today. Step 1. Move your emergency fund to a high-yield savings account. Do this week, not next month, this week. Step 2. Know your number. Calculate your true net worth. Assets minus debts. Be honest with yourself. Step 3. Attack any high-interest debt above 7% aggressively. Make a payoff timeline. Step 4. Open and maximize your tax-advantaged accounts. Roth IRA, 401k to at least the match, HSA if eligible. Step 5. Invest the remainder into low-cost index funds, something like a total market fund or S&P 500 ETF through a brokerage account. Set it up on auto invest. Forget about it. Let compound interest do the work. Step 6. Get your protection in place. Term life insurance, disability insurance, umbrella policy if you have significant assets, a basic will. That's it. 6 action items. None of them require a financial advisor. None of them require you to be a genius. All of them require you to start. Because here's the real truth about $120,000. It's not a destination. It's a launch pad. And what you do in the next 90 days will determine whether that money becomes $200,000, $400,000, or $1 million over the next 15 to 20 years. The people who win with money aren't smarter than you. They're not luckier than you. They just moved when most people stayed still. So move. If this video helped you, drop a comment below and tell me which of these 5 moves you're starting first. I read every single one. And if you want to go deeper, I've got a full video on how to build your first real investment portfolio from scratch. Link is right up here. Go watch that next. I'll see you in the next one. Take care of your money because nobody else is going to do it for you.